This time it worked.
We have successful execution on our bumper music.
Beautiful. All right. Happy Monday, Judah. Happy Monday.
Absolutely, dude. So Josh, I got my kid's principal puts out this daily little video of him talking for 3 to 5 minutes like elementary school principals do, and it's so sugary sweet it'll give you a cavity if you're not careful. Hi, boys and girls, this is Mr. Schwatner today talking to you about blah blah blah. I mean, he's great. I love him. I'm not making fun of him. I'm just saying he's exactly what you would think an elementary school principal would be. And he said today is Monday, the last full week of school. There's 2 more weeks after this one, but they're both 4-day. And you also know, like the last, 5 days of school, they're, such early dismissals and stuff like that, they don't count. So like the school year's over, man. Summer's here. Like, this whole shutdown thing has just, it's really messed with our sense of time, and all of a sudden here we are in summer.
Well, yeah, it's funny because I was talking to Anna Kelly. She's going to be on our show later this week, but I spoke to her like 2 weeks ago, and she was telling me her kids go to Mount Calvary.
Okay.
And it was right before their last week of school. I'm like,
right.
Last week of school, we're going into May. But man, the year has run by like so crazy. It's really nuts.
Yeah, absolutely. So I just talked to somebody this morning about listing their house. And, I'm going to be getting her some numbers and things like that. And one of the things that I told her is I've always been brutally honest with people, but also I hate when people are too nebulous with their answers. I feel like as a salesman, it's my job to rely on good data and be able to give good information. But I told her, I said, right now, I'm seeing there's enough information out there to think prices should be eroding. But there's also so little supply that, supply and demand kind of has that balance. I said, but
yeah,
it's also COVID-19. So who knows what tomorrow is going to bring? In politics, people have always said, and I'm a student of politics. I like following, political stories and everything like that. Sure. And in politics, they always say 24 hours is an eternity, because you never know what the other side's going to bring up, or you never know what, geopolitical event is going to happen. So well, in COVID-19, 24 hours is an eternity. There's been a number of times where 2 or 3 days has felt like, oh my goodness, I thought that 3 days ago, that feels like it was 3 months ago. And the same thing could be true moving forward in real estate. So right now I'm seeing great opportunities on prices like ROIs and stuff like that. We've talked about our REOs is the word I'm looking for.
I saw that
on.
Yep.
So now it's kind of like a perfect storm. It's the best of both worlds, because it's if you're looking to buy a property, there's great bargains already showing up. If you're looking to sell a property, there's not much inventory out there that you're competing with. Well, and if you're looking to sell a property, values haven't eroded yet.
So I got 2 bits of info on what you're saying. So I got off right before our show. I got off with a residential mortgage broker who deals with, I don't know, 200 plus property homes, right? Median home price properties. He told me, he said, I have 30 or 40 clients that have come to me over the last 2 to 3 weeks that wanted to get pre-approved for a loan. And they're like chomping at the bit, ready to get out and start buying. And which to me says, when these people hit the market, we're going to have a huge surge of at least sustained pricing, if not a bump in prices in the immediate future. But I think that once we see the fallout from, from the unemployment and what jobs do and don't come back, it'll be a little bit more of a sobering experience. So I think once we open up, like if this stuff with Governor Wolf kind of goes through and gets flushed out by the end of this month, and we've got people at least in yellow phases, yeah, exactly, the yellow phase across the state. If everybody can get the yellow phase across the state, maybe excluding Philly because it's kind of still a little bit of a mess. If that can happen, we're going to have a lot of people rushing back out and buying houses. And I think that there's a decent handful of people that have been waiting to put their house on the market and have taken this time to kind of fix it up and make it look just how it should. So I think the summer's going to be a pretty nice time to sell. If you get a flip midway through, you might be in a good shape.
Well, I think the other thing to remember is how people in lower incomes spend their money on fast food and video games and Nike sneakers. People at the median to upper income levels spend their money by excessively eating out, drinks at the bar being very expensive. I think that what's funny is, everyone's alcohol budget has probably gone down, but everybody's consumption of alcohol has gone way up, just because of the difference between what it costs to buy alcohol and drink at home versus drink out. And,
sure.
There's so much savings that's been going on right now. And it really takes so little amount of money to buy a house. If you're buying an owner occupied property, you have somewhat decent credit, somewhat decent income, you can get into that house for, 5% down. And a record number of people have that situation going on right now. There's just a lot of people who, because they're not spending money on vacations, people who make, 80, 90, $100,000 or, times two a year, usually spend $5,000 to $10,000 of that on a vacation that they just didn't take this spring. So that money is sitting in their bank account, and they are going to go out and spend it on a percentage of those people are going to look to, buy a new house.
Well, that's absolutely true. I think one other piece of the puzzle that we haven't really touched on yet in this conversation is FHA just came out and they said that they're willing to extend some of the abated mortgages or deferred mortgage payments for up to a year.
Wow.
So that could give people enough of a lead time that if they're going through a difficult time, finding a job, if their job disappeared, and it gives them enough time to kind of get their feet on solid ground again before, the bank starts talking about foreclosing and all the other mess that goes along with it. So, hey, who knows what tomorrow's going to bring, but it certainly seems like we've got some at least promising outlooks coming up here.
Yeah, exactly. And just like you said, who knows what tomorrow could bring? This could all change tomorrow, but right now, but that's always true. One of my favorite lines from Heat is when Al Pacino says, "You can get killed walking your doggy." We're always at risk. We're always at danger. There's always anything can change. And I think that we're seeing a lot of really good news. So you talked about how we're going to have Anna Kelly on. Let's kind of lay out the week here. So,
exactly.
So we're going to have Anna Kelly on Thursday. She's an amazing person. 10 years ago had $0 to her name, and now is a multimillionaire with, several hundred units under management. I saw it happen. I started working with Anna when she had about 4 units, 8 units, something like that.
Yeah.
And she's been a close friend. I've mentored her. She's mentored me. We've worked alongside each other and done a lot of really good stuff together. And I just have so much respect for her. I think she's an amazing woman.
Oh yeah, I mean, she told me that over the last year and a half, she added over 200 units to her portfolio, and we're talking about. I mean, her coverage area is small. Like we're talking about 2 small towns in central Pennsylvania, and she's got over 500 units between the two areas. It's phenomenal. It's phenomenal what she's been able to do. That's going to be great. But our topic or our focus this week is going to be on how to finance your next project, and today we're going to just kind of start from 10,000 foot view and take a look at number one, why not just use a bank, like with every deal, and kind of the differences between using a bank and why you would need to use it on the value add project or commercial project, whatever.
Right. And then commercial loans versus residential loans, hard money versus private money.
That's right.
And just what are the different types of financing and why would you want to use different ones? And I've worked in banking my whole life, and you have as well. And it's always been funny to me, people who have like misconceptions,
Yeah,
and they confuse different types of loans or different loan terminology, and they don't want to ask questions because they're afraid if they ask a question, they're going to seem like they don't know what they're talking about when it comes to money. So, this is a safe space to ask questions. This is a
that's right.
safe space to, we might cover some of this stuff in a little bit more basic terms than some people are used to. But I think you'll find two things. You will learn some things, and also you might be wrong about some things.
Oh, heck yeah. Heck yeah.
I mean, just a real quick example. The term evangelical, so no, I'm a Christian, born again, Jesus freak, all that stuff, blah, blah, blah. I was listening to a sermon on Sunday where this pastor was just defining a couple different terms. I was totally wrong on what evangelical means, like what that term means. I thought it meant one thing and it meant something different. And like,
Sure.
I'm a go to church every Sunday, grew up in the church. And
Yeah.
so it's okay to pay attention to some of this stuff, and I think you'll learn a thing or two, and maybe some things that you might be wrong with. So start us off, Josh. Where do we begin
As,
today's
as we
discussion?
jump in here, look, I'm Josh. If you've never watched the show before, with Hard Money Bankers,
We
Hard Money.
didn't promote. We didn't promote ourselves.
Right, exactly. So, Hard Money Bankers, we do private investment loans for real estate investments, not for primary residence. They're short-term loans, but because we're a primary lender, we can fund deals very, very quickly. We do acquisition and construction funding for fix and flips, for apartments, for small commercial, large commercial, everything from $50,000 loans up to 10 million, if that's what you're looking for. We can close within 24 hours so long as title's done. It's in-house underwriting. We can get you approved the same day. So that's it. That's it for Hard Money Bankers. But like, let's jump in here and take a look at what we're gonna be talking about today. So funding sources to bankroll your next investment project. The real question that I always had when I first got started, I had just bought my first primary residence, and was really didn't know what I was doing. I had two friends that we pulled a little bit of money, bought our first flip, and didn't even think about financing it. And this place was like the worst of the worst houses, overpaid for the property, under budgeted construction, did all the things wrong. But financing was really never really part of the conversation until we looked at our second property and then our third property, because really quickly we realized, hey, we don't have enough money to fund these things, right? And the biggest surprise to me was that, like, why didn't we just go to a bank? Well, it became pretty straightforward as we got into it. So, like, what I wanted to start with is kind of look at the difference, Judah, on what's the difference between buying a house with a conventional mortgage as opposed to something that's a value add project, whether it's a rental property that you're buying and going to refi once the renovations are done, or you're going to fix and flip the thing.
Yeah, I
Yeah.
love it, man. This is such a great outline of the loan
I'm sure I missed something.
process and everything like that. I did not look at these slides ahead of time. Are you going to make these available if people want to email you and ask for these
100%.
slides? Because I've been doing this for 15 years, and I'm thinking that I wouldn't have been able to come up with anything this concise or direct, or that has this much value. This is a really great overview of the lending process, my friend.
There we go. So, like, look, let's take a look at. If you want to email me, I can send out this deck to you. It's a PowerPoint presentation, no big deal. But let's look at this. If we've got on a retail sale, you think about it. If you ever bought a property on the market, first step is you got to go and get pre-approved, right? No agent's going to take you out unless you have a pre-approval letter. Well, most of the time, that's pretty simple, right? You're calling somebody in. They might run a credit check. They might not. They might do a soft pull to get an idea of what your credit looks like. And they're probably going to, ask you how much money you make, right? So you get an idea of what they can approve. Unfortunately, a pre-approval letter, and like, this is something I learned when I was actually selling flips. A pre-approval letter doesn't mean that you are approved for a loan. It means that they took a look at you and made sure that you didn't have a 400 credit score and no money,
Right. Yeah, I mean, 15 years of doing mortgages. Let me tell you, if somebody tells me I make $100,000 a year and their job sounds like it's a job that should make $100,000 a year, I don't even ask for, most loan officers would not even ask for a pay stub. So that means that they may or may not have pay stubs. They may or may not have like child support or other things like that coming right off the pay stub. They might have, back taxes that the IRS is garnishing their wages for that is coming off the pay stub. Like, just because somebody says they make $100,000 a year doesn't mean they have $100,000 worth of verifiable income. And most people, because they understand their own personal financial situation, they don't realize how jacked up other people's financial situations can be.
Yep.
And just all of the problems that there can be out there.
Well, one other thing about that, Judah, is that when you're looking at a conventional loan, believe it or not, when it comes to all of the different loan types, it's one of the hardest, maybe not hardest to get, but one of the types of loans that requires the most documentation, the most background, the most screening to get. So if you think about it, a pre-approval letter that that only requires a few basic tidbits of information doesn't really help you out. If you're selling a property, but kind of going down a rabbit hole here. But
it's one thing. It's one thing that always interests me about the banking world is, it's hard to start a business. It's hard to get into business. And, you have to have more money down for a commercial loan. And you have to, there's a higher level of just financial IQ that's required.
Yeah.
But I got to tell you, the documentation requirements on a commercial loan versus a residential loan,
totally different.
I'm not talking about a hard money loan like that you would do, Josh. Like, I'm talking about if somebody wanted to buy the downtown pizzeria and we went to, the local regional bank that has like 7 or 8 or 10 branches in your county and the county beside yours. You know what I mean?
Yep.
That bank will, with a much lower standard of documentation. So if I were to take your loan to a normal FHA, Fannie Mae, loan to get a Fannie Mae, Freddie Mac loan to do a purchase on your primary residence, that you're going to, eat peanut butter and jelly to make the payments on if you have to. If you send me 4 bank statements, but like paid the even number page is the back, and so therefore you didn't send it to me, you know what I mean? And I have page 1 of 4 and page 3 of 4, and you didn't send me, the other pages. FHA is like, nope, I need all pages. Your local bank is like, oh, I get it. That's just your canceled checks or whatever on the back of those pages. Don't worry, I don't need to see them.
On the flip side, if you are looking at a non-recourse commercial loan for $5 million, they're gonna pull your credit because they want to make sure that you're not a deadbeat. But they're basically looking at the asset, and that's it. You're going to have to bring 20% or have investors to bring 20% or 30%, but still they're loaning, a couple $1 million on the signature.
100% on the asset itself. I've done commercial loans. I've brokered commercial loans that were non-recourse, that the lender said, because it's not recourse, I don't want to base it on credit.
Yeah,
I'm not allowed to base it on credit. I don't want there to be a chance that somebody thinks I based it on credit. Therefore, I'm not even going to pull credit.
Yeah.
No joke. Like, some commercial, it's amazing to me the differing types of loans are out there. So non-recourse means the lender has non-recourse against you as the individual. They can take the property.
Yep.
They can do what they call force. What is it called? Where they
That's basically it.
Yeah, but what's it called when they take the rents?
Assumption of
rents. Assumption of rents. Thank you.
Exactly.
You're not necessarily signing away any of their ability to do those things. However, you do assign the rents, and they can do assumption of rents. But commercial and residential, vastly different worlds for good reason once you understand them.
That's exactly right. So let's go back to this. All right. So if you go through a retail loan, you get your pre-approval, you go out with your agent, you go and find the asset or the property that you want to buy, and then you put in your offer. It gets accepted. You put down the deposit, and then the real hard work begins, right? So once you have that contract, now you're sending that off to the loan officer. You're going to get your 3 or 4 months of bank statements, your tax returns. They're going to do a credit, a credit check on you. In addition to that stuff, they're going to do an appraisal on the property. In addition to that, once they get all this data, now they're going to ask you a ton of other questions. Why'd you spend so much on that new furniture set? Well, it looks like your car loan's coming up here. What are you going to do when this is paid off? You're going to go buy another car? My parents, when they bought their first house, they made my mother sign an agreement that says that she would not get pregnant for at least 3 years after they settled on the house. Now,
can't do that anymore.
Right.
Can't do that anymore.
But you think about that. I mean, that's outrageous. Who the heck are you? But the point is, it's an evaluation of risk, right? Like,
yes,
that's what the lender is doing. They're evaluating the risk that they're making when they give you this big lump sum of money.
Right.
And on a residential sale, even though most of these loans are backed by backed by a federal entity or whatever, they're going to sell these off on the secondary market. They want to make sure that most of the time people are going to pay their mortgage. Right.
And so they're valuing. They're looking at your ability to repay and also the value of the property in case you can't repay. Are they covered? Are they protected?
That's right. Now, once this is all done and you're settled, they're going to accept a small monthly payment at a low interest rate and a very high loan to value rate. And so It makes sense that if you're going to have a low amount of skin in the game, they're probably going to underwrite this a lot, which means they're going to make sure that they have all the information that they need to make a value judgment on whether they should loan you the money or not. Now, on the flip side, if you're doing a value add purchase, right? You're flipping a house. You buy in a rental property that is like a Burr method type situation. This process is a little bit different. Typically, you're not going out and getting pre-approved for a loan before you're going and finding the asset. You're going to go out and take a look at the asset. You're going to be analyzing it based on the numbers. What is it going to give me the return I want? You're going to calculate your offer, negotiate the contract. And once that happens, now you're going to either look for funding or deploy funding based on, if you've got, let's say, private money, or you have cash or whatever. The major difference here between a retail sale and these value add projects is that most of these properties that you're buying are not going to qualify for a conventional mortgage.
Right. The lender's going to say, yeah, it might be worth $100,000 when it's all fixed up, but it's non-habitable right now.
That's right.
The heating system doesn't work. The kitchen sink, when I turn the water on, nothing happens. It's a non-habitable property right now. It's filthy. I don't want to lend you money on this hoping you pay, because if you don't pay, I'll have to foreclose on it. And then this property is going to be a headache. I'm not interested in headaches. I'm interested in something I can list with my REO agent and get it on the market. And sure, I'm going to, take a haircut is what we call that. When they list $100,000 for $90,000. So I'm going to take a haircut to be sure, but I at least know what I'm getting. When it comes to properties that need work, banks don't want them.
Well, and it's not just that. It's anything that deviates from the norm, they won't lend on. And what I mean by that is, hey, did you ever use a wholesaler? Ever buy a property from a wholesaler with an assignment? I sure have. It doesn't matter if that place is perfect, half the value of, half fair market value, everything else conforms, they will not pay the wholesaler. And if they show up on the HUD, they'll throw the loan out.
Right.
Yeah,
exactly. So, perfectly legal, especially even if you do the taxes, in Pennsylvania, you have to pay double transfer tax. So even if there's the double transfer tax and everything like that, they're going to say the seller of this property is not the deeded owner of this property. That's fishy. We don't understand it. We don't care to understand it. We make our money on volume and razor thin margins. So therefore, the answer is no. The confused mind says no.
The other reason that you would use a some other source of financing, a big one, is timing. I mean, timing is humongous because if you need to close next week, there is no lender, no conventional lender that's going to be able to do that.
Right.
I mean, it's just not going to happen. You're looking at best case scenario if all of the stars align. Best case scenario, 30 days. Usually it's 45 on the low end and 60 on the high end, right?
Correct.
I mean, yeah. So timing, the conventional nature of the transaction, and the type of property and the condition are all going to play in here. So these are some things to keep in mind, right? Here's a couple different types of loans that we should talk about. First, we have conventional loans. It's pretty straightforward stuff. This is going to include everything from a small bank who's going to do a more traditional loan on a primary residence, or even a rental property.
What you're calling conventional here would be like owner occupied, residential loans.
Even non-owner occupied,
Well,
where
yeah.
in your personal name, that kind of thing. I mean,
Yeah.
you're going to see origination costs of probably about 1% ish. You may be up to 2%, but that usually about 1%. You're going to be looking at worst case scenario, 80% loan to value, and as high as 97, I think is the highest. And actually, with a VA loan, they even do 100%.
Right.
You're looking at rates right now. I checked the rates this morning. If you're doing a 15-year mortgage, it's 3%. And if you're a 30-year, everything else, you're looking at 3.67%. So, I mean, pretty low rates, like as low as you're going to get. And then the terms is going to be somewhere between 15 and 30 years, typically, right?
Right. Yep.
As we said, it's best for primary and best for a refinance if you can do it because it's in your personal name. The second type of money that we can talk about here is private money. Now, if you've ever flipped a house, and I mean, even if you've never flipped a house, private money is the best money. You've got the most flexibility. You set the terms, you set the timeline, you set what you're paying. The problem is a lot of people don't understand how to raise it and do it properly to protect themselves and the investor and everybody else involved. And who do you know that has $500,000 laying around that they want to lend you, right?
Right.
So private money can be difficult. Typically, this is going to be like loan to 70 to 80% loan to value. Interest rates around 8%, 8 to 12% is what you can expect. Usually, these are going to be for like short-term loans. And when we say private, we're not talking about a bank or an institution here. We're more so talking about like Uncle Billy over there.
Friends, family, people you meet at the local real estate investor club.
That's right. They're people that understand what you're doing and they want to help you out. These are great for flips, value add, or short-term holds. I mean, I've held short-term loans for like 3 to 5 years on investment properties that I just saw an area appreciating and didn't want to go through all the hassle of getting another loan. This can be a good option. Then you got hard money. Hard money. Over the last couple of years, people have really gotten a bad understanding of what hard money is because there's been so much bank and institutional funding that's flooded everywhere. Hard money got really cheap. I mean, there were places that you could get it from California for like 1 point origination and 10% interest. That's just those people aren't around anymore. I mean, they just don't.
Good luck getting to the table with it, though.
Well, now for sure. And the underwriting was much more like a conventional loan. You're looking at 45 to 60-day closing, whatever. When I first got started, hard money was 5 points, 15% interest, and that was the basement. Like it went
absolutely.
Up. Like you better have.
When I started doing hard money loans for people, if it was your first loan with me, it was 6 points. After I did 2 or 3 loans, I would drop it to 5 points.
That's right. So hard money is a little bit different of an animal. It's important with any of these that you got to be able to calculate the type of financing you're going to use into your purchase price, into your renovation costs, all that kind of stuff. You can expect anywhere from 3 to 6% on origination with hard money. Loan to value somewhere between 50 and 75%, depending on the lender. Rates are going to be anywhere from 12 to 15%. These are short-term loans. That's something to keep in mind. It's really hard to make money with a hard money loan if you're in the loan for more than 9 months. Unless it's like the 1 in 10 that we talked about earlier. Ideally, these are like 3 to 6, maybe 8-month loans that you can get in and out quickly. So we're talking value add construction, flips, fix and flips, and rentals. Then you've got residential commercial loans. This is for small apartment buildings and single families that are in an LLC or in your personal name, but you need a second source of funding, right? These are typically going to be loan values of 100 to 2 million in that range, 1 to 2% for origination, 70 to 80% loan to value. I mean, I've seen them as high as 85% loan to value, but the rates are going to be about a point to 2 points higher than what you would see on a typical conventional loan. These are not non-recourse loans, which means that even though the LLC owns the property and the money's being lent to the LLC, you are personally guaranteeing the loans.
It's very, very common. Very,
Yeah.
very common. Unless your name is Coca-Cola Incorporated, you're probably going to have to sign a personal guarantee.
That's right. That's right. One thing to understand about these type of loans, I mean, again, recently we've had a 30-year fixed rate mortgage for, these residential commercial loans, but typically they've been loans that are amortized over 20 years and they resets, which means that today there might be a 3.5% interest rate on there, but in 3 years or 5 years or 10 years, the loan either has to be paid off or it resets to the current interest rate. And so, that's why a lot of times commercial buildings are valued by their cash flow, because the financing that's involved in it has a big play in, what kind of money you can make off them.
Right.
Good for long-term rentals in an LLC, that kind of thing. And then you have the dream loan. The dream loan is commercial non-recourse loans. These are fantastic opportunities if you can get them. But as we talked about to begin with, number one, usually the basement on a loan value is like $2 million. Like that's just entry level, and they go up from there. You're going to have 1 to 3% origination. I mean, 3% origination on $2 million. That's big money. There's also a ton of attorney's fees and underwriting fees and all that kind of stuff that goes into these. And they're going to be in, loan to values are typically at like 70%. I've seen 80, but 70%. The nice thing about these type of loans that's I think really interesting is like they're usually best for like a syndication. So you raise $500,000, you go out and find a property that's worth, 4 million, let's say. Yeah, those numbers don't work. $1.5 million or 2 million, whatever it is. You raise $1 million and you're financing 3. Okay.
Right.
But for the bank, what are the chances that an apartment building is going to decrease in value by 25% or 30%? It's not great, because the value, again, it's based on cash flow.
Also, the other thing with non-recourse loans, commercial loans of that size, is what's funny is they click back over into 30-year fixed. Oftentimes, like they're long-term, there's long-term fixed options available with them of 20 or 30 years. They're also assumable, which can make it really nice for when it comes to sell them.
That's exactly right. Taz, really good question here. Original cost. So it's not original cost, it's origination. So what that means is this is what the lender is going to charge you just to process all the paperwork.
The points on the loan.
That's right. So it's like, on $1 million loan, you're talking about $10,000 to $30,000 just to process all of the paperwork and loans. And there's typically a bunch of other fees. The cost, the cost is like, let's say that same $1 million property that has more reference to the loan to value. So they're going to loan 70% of the value of that property. If it's worth $1 million, they'll loan 700,000. You got to bring 300,000 of your own capital to the table to buy that thing, plus the 30 grand in origination fees and closing costs and all that kind of stuff. Great question. So yeah, I mean that's like our overview for today to kind of look at and get a grasp on each of these. Tomorrow, what I'd like to do is dive into the first part of this and kind of look at the actual process of, the more long-term holds, right? Let's look at conventional financing, residential, or, commercial financing, and the commercial non-recourse. Take a look at like, what are some benefits of each, and what type of properties and what type of assets are they going to work best with, and like really take a look and dive a little bit deeper into, the details, I guess.
Yeah, that sounds absolutely excellent, my friend. We've got a great week of shows that we are lining up here, and so like us, share this video and things like that, because we're thinking that we're going to be able to really drive some really great value here for other people.
That's exactly right. And I just want to mention, every day we're giving away a free book of real estate hackers, or I'm sorry, property hackers. I get confused there. To the best comment of the day today, it's going to go to Taz. Thanks for the comments, and don't forget that June 26th to 28th, Real Estate Hackers 2020 conference is in Lancaster. You can go to realestathackersconference.com to register and for more information on speakers. We've got some awesome speakers coming. Coming to the next. Coming into the event.
Yeah, really looking forward to it, everybody. Thanks for a great show, Josh, and I'm looking forward to being back here at noon again tomorrow.
Wonderful. All right, guys. Have a great day. See ya.